Hello students and welcome back to one more session on financial management. In our yesterday's class, we have dealt with venture capital, the meaning of venture capital, characteristics and advantages. To have a brief recap, I will tell you once again about what is venture capital. So venture capital is nothing but the capital invested in risky ventures. Now, when we say risky means a venture is almost all the same. It means a risk, a risky project, a risky task. So why we call it risky? Because it is a new product, new business started by say young entrepreneurs or startups. So this is a buzzword in the 21st century. That startup culture means a unique idea, something new which is never done before is being trying to be developed. And so anybody investing in such a business, we call them as venture capitalist. So its basic characteristics are it is long-term horizon, it is risky, it is both funds and experience sharing, ownership between the idea generator and the person who is investing. So we'll move on to our next concept of venture capital, what you call it as the stages in venture capital. Okay, so stages in financing of venture capital. So first stage, we call it as seed money. Now, why is it called seed money? It is the money needed for proving that this new idea is good, worth investing. So I have an idea. I approach a financer, a venture capitalist, and show him my product, my business idea, and try to convince him to invest money so that I can germinate that seed. So my idea is there. Okay, that seed I have to put it and I have to, you can say, fertilize it. Seed is trying, we are trying to make it into a sprout. So you want to water, put fertilizer, sunlight, and make that idea grow so that the sprouts come out. So that initial money needed to make that idea visible, you can say a pilot product. So that type of money. So this is the very basic first stage of financing. So here we need minimum amount because you just want to prove that idea. Next is the second stage, which we call it as startup. So this is the funds needed for firms who want to spend on marketing and product development. Okay, so you have proved your point that this will be a good, wonderful product. Now I want to actually start the research and I want to actually start making that pilot product, do some marketing so that the product, we can say that this product is coming soon, something like that. So you are trying to make marketing and product development. For that you need some expenses, and that is the second stage. We call it as startup. Then the third round or third stage is first round. So here we want funds for early sales and manufacturing. So we want machinery, plant, a place. So basic infrastructure, then how will the product look like, what will be the sales. For that we need funds, so early sales. So that is the first round. Then second round, here we need the working capital. Now my plant is ready, the basic long-term assets are ready. Now I want money so that I can actually start the production. So here I have not yet finished my production. My pilot product is ready, my infrastructure is ready, but I need money to buy raw materials, to hiring employees, giving them salaries, overhead charges, and so on. Okay, so that money needed because I have not yet started making profit or not yet making sales. So that's the reason why I am so that person, the startup is wanting money for the fourth round. Then the next stage is called as the third round, also known as mezzanine financing. So here you have been become a well-established company, sales are happening, demand is high, your product is being known. Now I want money for expansion of my company. So mezzanine means debt financing, means I want to capture huge loans so that I can expand my newly profitable company, which is in limited areas. So every startup after some time, they want huge inflows of funds. That might be the fifth round, that is mezzanine financing, where they are taking loans or say partial investment from new partners also. Then the sixth uh, stage is a fourth round. Here and now it's a long, it's almost say few years from making a profitable company. Now the venture capitalist wants to take back his money. I told you that venture capital initially invest, makes that seed germinate into a plant, bear fruits, sell the fruits. I'm talking here in similes. Okay, actually we are not growing a plant here. I'm talking the business as a plant and the fruits as the profits. So once it bear fruits, it enjoys the fruits of profit for some time. Then okay, chalo, I want to get out of this company and invest in one more new venture. So that is the fourth round where I want to make my company public so that the owners can take back their funds. So what I'll do, I take back my funds, I will do an IPO. What is an IPO? I told you earlier, it is initial public offering where a private limited company tries to issue the shares to general public and gets it listed in the stock exchange. So the fourth round is for funds so that the venture capital can back off from that business, take back his funds and invest in one more company. So this is the six stages in the process of developing a venture capital financing. Now we'll study about the risk in each stage. So based on each stage we need that much. So there is a period where the funds are locked. Then what is the risk condition? We'll think about it. Okay. So the first stage I told you seed money. Here the money is locked for almost 7 to 10 years because you are just developing your product, a pilot product is being ready. The funds are used for research and development, conceptualizing your idea, supporting research and development, product development. So here, still nothing has happened. You're just moving on with the permutation and combinations of the, what is called as the idea. So funds are locked for say around 5 to 10 years. Risk is extreme because the product may fail many a times and then you may come out with the best product. Then the second stage, startup. Here also the funds are locked for almost 5 to 9 years. So initial operations, prototypes are developed. Here also, as the sales has not yet started, the risk is very high. Third stage, funds are locked for around 3 to 7 years. High risk. You are commercially starting the operations, trying to commercially produce the products and do its marketing. Then second stage, funds are locked for 3 to 5 years. Risk perception is sufficiently high. Here you are thinking about expanding market, growing by using working capital needs. Third stage, 1 to 3 years. Risk is medium because you have actually started production, profits are generating, you are expanding, acquisitions are there, you are expanding the firm, so risk is high, you are earning profits. Fourth stage, here we call it as mezzanine, the sixth stage we call it as fourth stage, where so in the third stage, that is a mezzanine financing, you are taking up loan to expand the business. The next stage, the funds are locked for 1 to 3 years. Then here you go for public, that is IPO, so that you can, that venture capitalist can back off and enter into a new capital. You're going public so that more and more invested, because the company is well settled, more and more investors, individual shareholders, prospective shareholders can invest and take the benefit out of it. Then we'll be on to the next part. So the venture capital investment process. So I said seed money and all that. Do you think every Tom, Dick and Harry, or say every person who comes with a new idea, uh, their idea is accepted and the money is invested by the venture capitalist? No, definitely not. There is a lot of round of talks, screening, evaluation, and then finally that project is approved. Okay, so when you say as a startup you want to have an idea, you approach a venture capitalist. So there is an initial screening about which type of market you are targeting, what is the product, who is the entrepreneur, how much experience is having, or what is his uh, background. So based on that, the initial screening will done. So after you see what is the product, what is the market, who is the entrepreneur, they are going to see what is the expected return. So this is a new product. Will it be commercially viable? Will the people accept it? If yes, what will be the return? In how many days you will get the return? So based on that, evaluation is done. And also, who is the entrepreneur? What kind of product means it is what kind of a risk, high, low, so high risk, high profits, but you have to be very calculative. As a venture capitalist, he will see that his money is not wasted. Okay, then finally the expected return and accepted risk is say considerably enough to get pleased, to be pleased by the venture capitalist. Then the decision of approving of that project is taken. So this is the process of approaching the venture capitalist and then finally getting the approval. So you are going to originate the deal. About means as a innovative business idea. As an innovative business idea, you are going to originate the deal. Means you have to make a project report so that you go to the venture capitalists, see all the things, make a deal about how much time the funds will be locked, what will be the profit sharing ratio, what are the market risks, expected return, what is the market product. So all that is done in the deal origination. Then the venture capitalist is going to do the screening. Screening means say like there will be many people who are coming with a new idea so that they get funds. So they're going to screen based on product, return, risk, profit, all that. Then evaluate it, then structure. So once you like something, maybe it is very interesting, attractive, then the venture capitalist will structure the deal. Means when all the funds will be given, how should it be used, what will be the profit writing ratio, and all that. Then post investment activity means after that investment is done, they are going to see how the things are going on, where are they invested, what are the budgets, and all those things. Then at the end, after the product is launched, profit is being generated. If needed, the venture capitalist I told you will back off after enjoying sufficient amount of profits. So it will go public and take back his funds and invest in another company. So that is the exit plan, which will be structured at the very early stage. So next is the process of investment evaluation. Now, research has proved that out of 1,000 business plan, only 6 plans have been funded by a venture capitalist. Okay, so 5% of the business plan only are read beyond the executive summary. Means you go with a project report of getting the investment. So after the 2 or 3, so you have a synopsis or executive summary of the project. So before going to the 4th, 5th page, 5% of the business plans are, you say 95% of the business plan go in the dustbin. Means they will not be read after the executive summary. Okay, 10% of the proposal pass the initial screening. So first stage only 10% pass. Then 10% are of pre-screened proposals by due diligence. So here, this stage only 10% of them pass. So at the end, the funds who get is only 6% of them. So we have opportunity introduction, initial screening, due diligence, and negotiation. So say here we have 1,000 business plans are coming. Only 950 will go to the second stage. Only 900 will go to the third stage. And finally, funding will be given only for 6 plans only. So you can see that how difficult it is to get a venture capitalist. So your idea should be that really strong, then only your proposal will be funded. Okay, so this is all about the stages in venture capital, how things are done, for how much time the risk is there, the funds are locked, what are the for what are the funds used in each stage. So I hope you have understood this. Please comment so that if you have any queries, I will definitely see that in the next class it is being solved. And like, subscribe, and comment to my channel so that you can get notification of my next video. So that's all for today. Have a good day. Bye.